So, good afternoon, everyone. And we're going to discuss financial accounting, class 3. So, the people who are new to this class, make sure that you will watch class 1 and class 2. We are discussing the basics of accounting. So, we were discussing presently the basics of accounting. So, those people who are new to this class, make sure that you will watch class 1 and class 2, and then you can also watch class 3. So, my classes is eventually like 1.5 hours to 2 hours because it's a class like a normal face-to-face class. So, the people who are new to this channel, make sure that you subscribe and press the bell icon so that you get the notification as soon as this class gets started. Then make sure that you also, if you like the class, and just press a like button. So let's start. So yesterday we were at preparation. We were done with general entry. So, and also we have discussed about subsidiary books. Okay, then we have also discussed about subsidiary books. Then what I do right now, I make sure that I'll just give some important entries which will also useful for your practical purpose. So there are some important entries, the general entries, certain important entries we need to discuss. So those are outstanding salaries. The first one is outstanding salaries. What is mean by outstanding salaries and what is the entry we need to pass for the salaries. Then accrual entries, prepaid expenses, then you also get TDS or GST payables and prepaid GST payables, outstanding salaries, and these are the minimum entries which you have to remember. Okay, then entries for personal drawings. Yeah. So this is an important concept which you have to remember. This is an important interest where you have to remember. We will go combination with whenever we purchase how we have to pass a general entry for GST and GST input tax credit and output tax credit. That is also you should learn. Then let's start with this important entry. The first one is outstanding salary. The first one is outstanding salaries. So as we doing on the basis of accrual basis of accounting, when we do accrual basis, when we follow accrual basis, then one thing you have to remember, you should have two entries. That is, one is due entry, then next is payment entry. For everything you have to pass when it's fallen due and when it is made a payment. For example, on 31st March, every employee's salary will fall due. Okay, will fall due. And what happens between 1st March 2016 2 and 31st March 2016. For example, take 2/3/2016. Here we call it as the salary is not fallen due. We can say that salary accrued but not fallen due. Means your due date will come under 31st 3 2016, right? So there's a two different things: salary accrued but not due and salary due. Okay, people will get confused with salary accrued but not due and salaries accrued fallen due. Sorry, it is fallen due. Even though accrued but not due, we pass the same entry, but the thing is there's a difference between accrued but not due and fallen due. Now, whenever salary got due, then you have received services. The gain you have got services in from the employee. So let me describe whether it's a revenue expenditure or capital expenditure. If it is to call it as a capital expenditure, it should be non-recurring. Means the employee should work only for once in a year. Then one day it is non-recurring. It is not a part of your business, but it is a part of your business. I can say it is a part of. I can't say it is a whether it's a part or not part. But it was it recurring or not recurring? So it is not recurring. It is recurring. I'm sorry. It is recurring. So every month you pay salary. So it's called revenue expenditure. As soon as you call revenue expenditure, we call it as an expense. It falls under nominal account. Okay, the next one is the employees. Because you haven't paid, when it is fallen due, it means that you haven't paid. So you have your employee have a right on you. So next is employee's name. Then it's a falls under personal account. Then I'll apply the real account. So you can imagine there is a thousands of employees in our organization. At least there is a 10 to 20 employees. So it is not possible for me to write each and every employee name. So what I will write this employee with another name called outstanding salaries. This is I will call as a representative personal account. Okay, so I will call this as outstanding salary, and that I will call it as becomes a representative personal account. So whenever it is a representative personal account, it's nothing but your personal account. So what is the rule for personal account? Debit and credit. Debit the giver, credit the receiver. And salaries is an expense, as we say. So rule: debit expenses and losses, credit incomes and gains. So whenever it's fallen due, fallen due, so expenses comes on the debit side. So salaries account debit to outstanding salaries account. So that the user will understand. So this is salaries fallen due, then we need to pay to them, still not yet paid, right? Next part is a payment entry. So whenever you make the payment, maybe on the 10th you're making the payment, like your payment will be done next month 10th. So your entry will be, so what you're sacrificing here, you're going to sacrifice cash. What you're gaining your right back, that is from outstanding salaries. This is nothing but from your employees. Instead of writing employees name, I was writing outstanding salaries. So you have two things, cash and this, and cash falls under, you can see it is falls under real account, debit and credit. debit what comes in, credit what goes out, and it is also falling under personal account. Debit the receiver, credit the giver. So as per our transaction, the cash is receiving the employees. So I will write employee's name on the debit side. So my entry will be outstanding salaries account debit. My cash is going out. So to cash account. This is an entry I'm going to pass for the payment. Okay. So when your fall accrual basis, you will have due entry as well as payment entry, or if payment is done before and you will get payment into first, then you will also get the due entry. To come to next explanation, so we're done with an outstanding salaries. What is the second entry we have to learn is accrual entries. So accrual entries are same like outstanding salaries. So for example, we need to pay an interest. Okay, so you need to pass due entry as well as payment entry. When it is fallen due, so I bought a service, because that I have to pay in the form of interest, and because for example I bought a loan, because of that I have to pay in the form of interest. Whatever the benefit I've received, I have to pay in the form of interest. So I'm getting the services, so I'm gaining the services in the form of interest. Then I also sacrifice what my future right to someone. Okay, the future right to someone, I will write interest accrued. So I have two aspects. One is interest, second one is interest accrued. Instead of writing the person name, because you might be paying interest to several people or several banks. So what happens if I take a loan, bank loan? You can also use, instead of interest accrued, you can also use bank loan account. Okay. So interest accrued, ultimately we take to this accrued account to the bank loan or any other loan if you have taken. So interest account debit to interest accrued. So generally what we'll do, interest is an expense because it's incurs every month. So it comes under nominal account. Nominal account, you have debit as well as you have credit. Debit expenses and losses, a credit income sign gains, and interest accrued is nothing but your personal account, and receiver and giver. So he is a giver of these services. Then here it is an expense, so my entry will be expenses account debit to, sorry, that expenses is nothing but, here we will write interest account debit to interest accrued account. This is entry I'm going to pass. Then whenever I make the payment, interest accrued account debit to bank or cash account. So this is entry I will pay whenever I make the payment for interest. If it is a interest was received, interest is we need to receive the interest, then I have to receive the interest. So then there is due entry, then there is a receipt entry. So if I have to receive, if receipt as an income for me, if it's a fallen due, there I having what I'm gaining here, I'm gaining a future right on someone, because of I'm providing some services to someone in the form of interest. So I have interest as well as interest receivable. This is nothing but representative personal account. The due to why am I using? I may be receiving from the lot of people. Like I may be given, I have a customers or not a customers. I may be having a lot other people have given loan for or I have given money for. Then I have hundreds of people where I have given money for. Then it's impossible for me to write each and every name. So I will write replace with a name called interest receivable. Or you can also write, if there is a one or two persons, you can write their names. If there is a more than one, 5 to 6 people, what you can do, you can represent their name because they're having the same characteristics with another name called interest receivable. So in again, you apply this as a personal account, then debit the credit receiver and giver, and here also income it will become because it's coming regularly. So revenue receipt. So nominal account rule is what? Debit in expenses, credit incomes. Okay, then this is an income, so comes on the credit side, and he is a receiver of the services. So my entry will be interest accrued account debit to, sorry, I'm sorry, my entry will be interest accrued to interest account. So when I get receipt, then I will reversal this entry with the cash. So I'll cancel interest accrued. So I'm getting money, bank account debit to interest accrual account. Okay, sir, how it is this possible, sir? So I'm gaining cash, sacrificing this the right which I have earlier. I'm just giving up this right. So interest accrued. So bank is comes under real account, or some people it is called as a personal account. Whatever it is, the rule debit and credit comes in, goes out, and accrued is a personal account, receiver and giver. He is the giver of the cash, so it is coming in. So my entry will be bank account debit to interest accrued account. So next is prepaid expenses. I will try to explain here itself the prepaid expenses. So let me make you understand what is meant by prepaid expenses. Generally what happens, university concept or matching concept says that you need to recognize only income which is going to be accrued in this particular year. Means if you started from 1st April 2017 and 31st March ends here. So you have to track the transactions which was accrued only during the year. Okay, accrued, it means it have done in this particular year. The prepaid expenses is the expenses which you have paid, or prepaid income means income received in advance which you have paid relating to the coming year. Okay, it will gonna fall in due for this year. Okay, so you're not able to recognize this in your P&L account, and you should not recognize that as, see, it's not that you will not recognize that, but you will not recognize that as an expense. Okay, so you will recognize that as an expense when it is falling due. So what I will do, whenever I make the payment for the prepaid expenses, generally I will consider, see, for the next year I have to pick up from around 50,000. So today itself I'm paying. Okay, so this prepaid expenses, whatever it is there, I'll treat as my asset. Okay, whenever that expenses fall in due, I will compensate with this instead of paying. So I was paid earlier itself. So by making this payment, what I'm gaining some right on that particular person to make me service. So that person name I will write as a prepaid expense. Then you also losing cash for that. So my cash comes under real account, rule of real account, debit and credit, what comes in, what goes out. Then prepaid expenses is a personal account, debit the receiver, credit the giver. So whether he was a receiver of this cash or a giver of the cash, the answer is he's a receiver of the cash. Whether my cash is going out or coming in, the answer is going out. So my entry will become, okay, this is will be my entry. If any, if we have received in advance, okay, if someone, we have paid to someone in this case, if someone has paid us in advance, so that will become a liability for me and I was obligated to him to do the services. Okay, what I will do, what I'm getting cash. So bank or cash account debit, income, so bank or cash account debit to income received in advance account. This is my liability and this is nothing but your representative personal account. Okay, we're done with this. Let's move to another entry. Entries for drawings before we entries for TDS and GST payable. So before I'm taking this entry, I just wanted to make you understand what is meant by TDS. This is nothing but tax directorate source. Generally what happens, for example, I taken a salary. Okay, I just for the convenience we are taking salary. So for example, here is an employer, here is an employee. For example, his salary was 10 lakhs. Imagine, don't imagine slab rates and all this stuff, just imagine in India tax rate was 2%, or just imagine tax rate was 1%, or imagine tax rate was 12%. Okay, so he has to pay him 12,000 tax on this particular 10 lakhs. Okay, the monthly salary of this guy was comes around 10 lakhs divided by 12. Don't take this to easy purpose, I make it 12 lakhs and tax rate is 10%. So his monthly income was 1 lakh. So he has to pay a tax of 1 lakh 20,000 every month, per annum. Okay, means if I calculate every month 1,20,000 divided by 10, 12,000 he has to pay as a tax to the government of India. So he will pay at the end of the year. Okay, 12,000, 1,20,000 he has to pay anyway. So what government of India is did, because they wanted to get money in advance, they said to the employers, so whenever you're making monthly payments, you'll pay monthly salary of 1 lakh. Okay, do one thing for us. While you're making this payment, just deduct whatever tax he has to pay. Okay, calculate per annum divided by 12. Okay, whatever tax he has to pay on this 1 lakh, that you pay right now. While you making payment, what you will do, from this 1 lakh rupees, deduct that 12,000 rupees, and you just pay him 88,000. Okay, you just pay him 88,000, and this 12,000 pay to us. You got the point? So what employer has to do? He has to deduct 12,000 and he has to pay that to the government. Okay. Then when I was passing my salaries entry, the salaries accrued was salaries account debit. How much it is? 1 lakh it is accrued, because my expense is 1 lakh. My expense is 1 lakh, so I should write 1 lakh rupees as my expense to bank account. Or like, if you like, while you making a payment, it's always while you making the payment. So I just cancelling that outstanding entry, just I'm writing direct entry. So salaries account debit to bank account. So you're not going to pay total 1 lakh, you just pay 88,000. So what about the remaining 12,000? Remaining 12,000 is a liability for him. TDS payable account 12,000. It is generally liability for the firm. Till this get paid, it will stand as a liability. It is a representative personal account. Okay, this is a representative personal account. This will not go to the profit and loss account. Most of the people try to show TDS payable in the profit and loss account, but remember one thing: TDS payable will not appear in profit and loss account. It should appear in the balance sheet on the liability side. So as soon as you make the payment, to the government, then we will pass an entry: TDS payable account debit to cash or bank account. You may heard in your income tax, if you read about your income tax, you will see in your business or professions what happens if you are not deducted TDS. First case, what happens if you're not deducted TDS and you made the payment, and you also see what happens you are deducted the TDS payment but you haven't paid to the government. And third category, what happens if you deducted the TDS payment and you made a payment in the next year to the government. You have this kind of provisions in the TDS. So whether I have to claim these salaries as an expense in income tax or not, it depends upon whether you have deducted the TDS or not. Even your deducted TDS, whether you paid to the government or not. Okay, so this is how you will pass. When you do GST, generally what happens, GST is nothing but just take as a sales tax. I'm a purchaser. I'm not a seller. I'm just a purchaser. What generally happens if I was a purchaser? Here the seller will have a price plus GST, right? The price 50,000, and just imagine GST as a 5,000. Okay, then I bought this good, right? I bought this good. I'm also a businessman. I'm also doing a business. So I paid 55,000 to him. So out of this 55,000, the price is 55,000, but 5,000 is a GST. 5,000 is a GST for me, that I will get some input tax credit. What happens? I will get some input tax credit. So how much I paid to him? Say I bought a purchaser's account debit to bank account. If you write 55,000, 55,000. So if you look at the provisions of accounting, when you had any cost of a good, if you wanted to say my purchases of 55,000, if you included this 5,000, when you have to include when you're not claiming any input tax credit. when you're not claiming any input tax credit, you can include this 5,000 in your purchase cost. But if you're claiming any input tax credit, you're not allowed to include it. You just write 5,000. So what about remaining 5,000? Because you're claiming input tax credit, you will write an entry called input tax credit account. This stands as your asset, which is current asset. Okay, that we will come that to the next. Before itself, I'm explaining if the cost of purchases or cost of machinery or cost of purchases will include tax. Okay, any sales tax or goods tax which is, remember carefully, which is not refundable. If it is refundable, you cannot include in the purchase cost. You cannot take the double benefit. First thing, you're included and you're paying lesser income tax, and you're lowering your profits. Then you can also cannot claim as an expense, because that's not an expense. That's an asset, because you're claiming as input tax credit later on. Then this is a one point from point of view of purchaser. What about to the seller? So what seller will do, I got bank account debit, I got almost 55,000 rupees. My sale value, price of the goods, sale account debit 50,000 rupees, and GST payable account 5,000 rupees. So my sale value will not include, when I was booking the sale value, it will not include my GST. Just because that money is not belongs to me. That is not my income. That's the income of the government. How can I say that is an income of mine? So that is an income of the government. I will keep in a separate account called GST payable. As soon as I make the payment, I will pass an entry GST payable account debit to bank account. So one in the credit debit side and one in the credit side will get cancelled automatically. So this is an entry for GST payable, and I think already we have discussed drawings entry when you're drawn for the personal purpose, when you're drawn personal purpose goods, and you're drawn cash. What is the entry we have to pass? That we have already discussed in the class 2. So next what we're gonna discuss is from journal entries or from subsidiary books, how we need to post the ledger accounts and what we have to do. So wait, I will change into the whiteboard. Yeah. So next concept we're going to discuss. So what is the next concept we will discuss? How to post from the ledger, from general entries to ledger posting. So generally what we will do, from the journal entries we start posting to a ledger, or from subsidiary books we need to pass to ledgers. Let's see. I'll take some of the transactions and I'll start passing the entries. See, I'll just tell you a business model, then we will discuss that. Then see, for example, I started my business with rupees 5 lakhs. With this 5 lakhs, I went to the shop and I bought a furniture worth of 30,000 and machinery worth of 2 lakhs, and also bought a goods for doing the work. I bought a goods worth of 1 lakh. So 1 lakh, 2 lakhs, 30,000. Then I made a sales during the year on credit, on cash 60,000, and this is also 60,000. So let me pass entries for this. So first I bought a furniture, and first I started business with a capital of 5 lakhs. Then I bought the goods and a machinery and made a sales of 60,000, 60,000. So my first entry when I bought the cash for the business is cash account debit to capital account 5 lakhs and 5 lakhs. Then when I bought furniture, my entry will be furniture account debit to cash or bank account. This also cash or bank account. So how much it is? 30,000. 30,000. When I bought a machinery, so it will be machinery account debit to cash or bank account. Here it will be 2 lakhs and 2 lakhs. Then afterwards I bought a goods. Then my entry will be purchases account debit to creditor account. I just take 50,000 as cash purchases and 50,000 as credit purchases, and then purchases account debit to cash account 50,000, 50,000. The next entry I'm going to pass about sales entry, that cash account debit to sales account 60,000, 60,000. Then data account debit to sales account 60,000 and 60,000. So my problem, so if this is what my cash journal entries, so what I will do, for each and every transaction, for each and every journal entry, I will create a ledger account. So first it is started with cash, then I will first start with the cash ledger account. So my first ledger will cash and bank account. So debit side and credit side. This is my amount column. Okay, now just let's see, was cash in bank was there on this side, so debit side it is there. So I will go to my cash in bank account. I will write on the debit side, of cash account to capital account 5 lakhs. Okay, then the next entry I had And the next entry, next in the same entry, next one I had capital. Then what I will do, I will go back to here. I will open ledger account, capital ledger account, a credit side and the debit side. So capital was prevailing on the debit side, is there on the credit side. So I will write on the credit side of capital account by cash 5 lakhs. Okay, then next, furniture. I didn't open furniture account yet, so what I will do, I'll just get back here. I will open furniture account and credit side, debit side. Let's see which side is furniture. Is there furniture account debit to cash account? The furniture was there on debit side. I will write to cash or bank account 30,000. Then see next after furniture, what is there next? So next is done, and next one is cash is there. So now there is already cash account I've created, so there is a no need of creating again. So the cash was there on credit side, so I will get back to here. On the credit side of cash account, I will write by furniture. So it is around 30,000. Then after, there is also machinery. Let's see, machinery was on the debit side, so I have to create a machinery account, and cash is on the credit side. There is no need of creating cash account because I already have created. So on the credit side of cash account, I have to write by machinery. So here I will write by machinery 2 lakhs. Then machinery debit side and credit side, I will write to cash account 2 lakhs. So cash is on the credit side, so I have to write on the credit side 2 lakhs, 2 lakhs. Then next is purchases account. So I have to check whether I have the purchase account or not. So I don't have a purchase account. Now I have to create the purchase account. So credit side and debit side. So debit side of purchase account, debit side is there, purchase account is there on debit side. So what you will do, you will write debit side on the debit side of the purchase account to creditor account. You'll write amount 50,000. Then you should also write creditor account. A creditor was there on credit side, so on the credit side of creditor account you will write by purchases. Then you also had to cash 50,000. So in the cash ledger, you get back to the cash ledger. Get back to the cash ledger. So get back to the cash ledger. Like I was just write down buy purchases 50,000. I'll write capital here. Okay. Then after the same way you continue with the next. I have done with this, and the new account I don't have this cash, and so the next entry may you have cash was on the debit side. So what you will do, you go to the cash account, write down on the debit side of the cash to sales. You'll write here to sales 60,000. Then next is you having sales. Then you will create sales ledger, sales account, credit side and debit side. So sales there on credit side, if you observe, so buy cash on the credit sales of sales account, buy cash 60,000, buy creditor account 60,000, and you should also prepare the creditor account. So in the creditor account you will write, sorry, you should also prepare debtor account. So in the debtor account you should write debtor. If you look at debtor was there on debit side, in the debtor account you will write buy sales to sales 60,000. So this is how we need to prepare from the ledger posting. We need to do from journal entries, we have to post ledgers like this. So this is a class mostly focused on those people who was not good in financial accounting basics. So whatever it is, then after you post to the ledger, then you start balancing the ledger account. After you posting is done and you start balancing the ledgers. So first, I never and ever try to balance the cash account first. First, we have to do balance other accounts, then we go to the cash account. So first, there is a no other transaction for this, and let's see whether it's a personal account or nominal account. Capital is a personal account, so now you can balance it. So how much it is to balance carried on, which means I will take to the next year, the 5 lakhs. Then the furniture is an asset, so real account. So then you can balance it. So by balance carry down 30,000. Then machinery account, asset, real account, tangible, then you will balance it by balance carry down 2 lakhs rupees. Then so by purchases here it will be 50,000. So then this creditor is a personal account, so I will write to balance carry down 50,000. So as I already told you, the personal accounts and real accounts should be balanced and carry forward. So it's purchase is an expense. So when it is an expense, it's a called nominal account. So I will not carry forward to the next year. What I will do, I will make sure it will be goes to the P&L account. 1 lakh rupees. I already told you all the nominal accounts will go to the P&L account. All the real and personal accounts will goes to balance sheet. So as already we discussed, nominal accounts and so next is sales is nominal account. So to P&L account 1,20,000. So debtor is a personal account and you will write by balance carry down. That's it. I have closed each and every account. So let's see. Now we need to go to cash account. So so 30,000 plus 20,000, 2,80,000. And this is 5,60,000. So 5,60,000 minus 2,80,000. 2,80,000. So 2 by balance carry down 2,80,000. So generally we'll take total amounts, just total it, and total is just right here. Then remember one thing, which side is more. So which side is more, we'll call it as that balance. So if cash is more, cash is showing more balance on the debit side, we call it as a debit balance. If cash is showing more balance on the credit side, we'll call it as a credit balance. So which side is a more balance, we'll call it as that balance, that particular balance. So capital showing credit balance because credit side is more, so that's credit balance, it's showing the credit balance. And furniture is showing debit balance, debit side is more, then we call it as debit balance. So let me conclude one thing. So generally the increased side of the asset, in the modern rules were debit side. So remember one thing, if any ledger account shows debit balance is called asset, if it is a personal account or if it is a real account. Any nominal account, we'll call it as expense, shows debit balance, we'll call it as an expense. If a real account and personal account shows debit balance, we'll call it as an asset. If nominal account shows debit balance, we'll call it as debit. See, debit balance, we call it as an expense. Next, liability generally shows you credit balance, and income is also shows you credit balance. Means income ledger will have credit side more balance as compared with the debit side. So then next is capital. Capital shows credit balance, means in the capital account your credit side will be more as compared with the debit side. So what happens if it is debit side, we should not call it as capital. Yeah, you have to call it as a capital, but you should not show as a liability, you should show as an asset. In earlier you should show as an asset, now you have to show as a negative capital. So in the balance sheet of modern balance sheet, no, present balance sheet, we cannot show the negative capital. That we will look when we do company accounts, how we have to show. So now it's came. So what we'll do next step is we will prepare a trial balance. So trial balance, you have like this, you will prepare the trial balance. Like this, debit side, you will also have a credit side. So what is the purpose of trial balance? The first purpose of trial balance, it will find out if there is any errors. Okay, if trial balance is not tallying, it means that you have any errors. We will see in the rectification of error. So to understand the rectification of errors and other chapters, this is very important to understand how we will prepare trial balance. So if any account shows a debit balance, we will write on the debit side of the trial balance. If any account shows a credit balance, we'll write on the credit side of the trial balance. It's just a side. I'm not taking debited or credited. It's not a trial balance, it's not an account. It's just a balance sheet. Like this is just a sheet which represent all the balances. So first check out the cash balance was showing 2,80,000 and debit side is more. So in my trial balance, what do I do? In my trial balance, I just go to my trial balance. I just wait. So I just go to my trial balance. I will write. I'm literally sorry for so slow teaching, but it's very important to understand so that we can easily understand further chapters. And this class is for those people who weren't good in basics of accounting. Those people who was good in basic accounting, there is no need of listening this class, because this class is focused morely on those people who haven't done properly, who haven't done accounting properly. This class is majorly focused on them. So I will write cash. So what is the amount of the cash? So even it is not working. Here it is, 2,80,000. The closing balance of cash was 2,80,000. It is on the debit side. It's more on debit side. See, people generally think that where is a carried on balance, that side I have to write. It's wrong. You should write on that side which is a more. Means if 5,80,000 on the debit side and 2,80,000 on the credit side. So debit side is more as compared with the credit side. So it shows the debit balance. So we will write on the debit side of trial balance. And next is capital balance was credit side is more, and so that's the reason we are writing carried on balance on the debit side, because it is less. So which side is less, that side will write carried on balance to level accounts. So 5 lakhs on the credit side, so it's showing the credit balance, so I will write capital on the credit side, which are 5 lakhs. Then let's see another account, the furniture showing debit balance. So that's the reason we are writing on the credit side. So furniture 30,000. Sorry, furniture debit side 30,000. Then next is furniture account is done. Then you have a missionary account. It's showing debit, showing debit side is more, so it's showing debit balance. I will write on the debit side of this account missionary account was 2 lakhs. Then next, purchases, which showing debit balance. Even you transfer to profit and loss account, but write the balance amount. It is 1 lakh rupee. So my purchases are 1 lakh on the debit side. Then let's go to the sales. Next is creditor is there. Creditor showing credit balance. So that's the reason you have written carried on this side. So write creditor 50,000. Then next write down, sorry, sales showing credit side is more. Then write down sales 1,20,000. Then next you had data was showing 60,000 and debit side is more. Then data debit side 60,000. Okay, so sales have we taken? Yes, we have taken sales 1,20,000. So creditors 50,000. So if you count on debit side and if you take on the credit side, it must be equal. So then you have no errors. So I hope that will become true. Then let's see, then after we have to prepare a profit and loss account and or a balance sheet. So real account, every real account is an asset. It comes under debits. It comes under asset side. Okay, whether it's a current asset, whether it's a fixed asset, and personal account can be of liability. It can be of asset. If it is an asset, comes under asset side. If it is a liability, comes under liability side. A profit and loss account, all the nominal accounts will comes under profit and loss account. If it is an expense, it comes under debit side. If it is an income, it comes under credit side. So this, like, why I'm giving all these things, like I just wanted to give an overview of how from the journal entries or subsidiary books, from that how we will turn that into the ledger posting, from that how you go into the trial balance, then that how you will post into the profit and loss account and the balance sheet. Okay, so just we have to pick what are the nominal accounts and whether it's an expense or not expense. So we will also discuss, when we are discussing profit and loss for sole proprietor, we will also discuss direct expenses and indirect expenses. All the indirect expenses will give to the profit and loss account and all the direct expenses will go to the trading account. And that we will discuss, and we will also discuss how tally will also work, how we have to work on the tally and how we have to work on the SAP. So this was the thing. So basically we discussed the overview of accounting cycle. We have discussed the basic overview of accounting cycle and we have also discussed some of the important entries. Then what we have to do right now, we have to discuss some basic concept, application of some concepts. Okay, it's like matching matching principle or matching concept. what these concepts and also periodicity concept. So what periodicity concept says? Periodicity concept says me is you have to every year you have to write your profit and loss account. Okay, every year you have to write your profit and loss account. That year what you have to do, you have to take only those things which was accrued during the year. Anything which was accrued or happened during the year, that things you have to take care of. Means if I started 1/4/2016 to 30/4/3/2017, what it says, whatever happened this year, whatever it is, if it is happened, you have to consider when you're writing your P&L account. And at the end of the year, you have to show, at the end of the year, I'm not writing line here, you have to show your position. Generally, remember, profit and loss account shows the performance of the company during the year, and it shows a balance sheet shows a position on a particular date. The generally will take the loss date of the year. So it will shows what is the position, whether company was in a good position to pay off their debts or not, on how the company is performing, whether they are earning profits, whether they are earning losses. So that's the reason it starts from here, ends from here. And it is not in the balance sheet, I'm not going to represent whatever happened in this particular year. I'm not going to represent. I will write only those items which was there on that particular date. Okay, if for example I bought an asset. Okay, I bought an asset. Okay, I sold in between the year. It has happened during the year. Answer is yes. Do this asset comes on the balance sheet, in the balance sheet? Answer is no. Reason, it will not come because it was not there on 31st March 2017. Okay, I will write only those assets or liabilities which was there on particular date. Okay, second point, when comes to the nominal account. When it comes to the nominal account. So when it comes to the profit and loss account, I will show only those nominal accounts which was happened during this year. That's what my periodicity concept says. And so it not only talks about profit and loss account. Then while I'm recording, okay, I will record every transaction as per periodicity concept. Okay, I purchased an asset, I will record during the year. Yes, I purchased during the year, I record. And I sold during the year, I will record. Whatever happened during the year, you have to recover. But matching principle is only for profit and loss account. It's not talking about balance sheet. It will talks only about profit and loss account. What this says, it overrides periodicity concept. Periodicity concept says whatever happened during the year, you have to record. But matching concept says you write only those expenses which are matched with your income. Okay, you have to record only those expenses which are matched with your income. Okay, means those expenses you are incurred to get an income, that expenses only you have to write. Then any other expenses you should not write, even it is happened during the year. Okay, for example, I made a purchase. I made a purchases of goods of 50,000 units during the year. Means during the year I purchased a 50,000. As periodicity concept, you have to record it as I'm recording it. But when you goes to the profit and loss account, your profit and loss, your matching principle will override your periodicity concept. Okay, so out of this 50,000 units, I have sold 30,000 units. Okay, out of that 50,000 units, I have sold only 30,000 units. So means that I have got revenue is from selling 30,000 units, not by selling 50,000 units. Means 20,000 units was not incurred to get this revenue, only have incurred 30,000 units. Okay, so I should not show this as an expense in my P&L account. So I should only consider 30,000 units as my expense. Even it is happened, the 50,000 I have purchased during the year, but I will only show 30,000 units because that is based on matching principle. And matching principle also in combination of revenue recognition principle says that whenever you are recognizing, see, they talk on the expense side, then I have how I have to, which expense I have to recognize, and income side when I can recognize my income. So income side, it says that you can recognize an income. First point, you are capable of saying that your expenses incurred to get this income. The first point they are saying, you must be capable of whatever the expenses you incur, you need to calculate this is the expenses I have incurred and this is the income I got. You have to be capable of saying that, and you should be sure that whatever the income you will getting, that will be receivable, and there is a possibility of receiver. Okay, there is a possibility of receipt. For example, you sold to a person who is died. Is there any possibility that you will receive that income? Answer is no. In that case, you should not recognize that income. Okay, sir, what happened this? Sir, I've sold a 50,000 rupees of goods to one person. There is a possibility. There is a possibility that he will pay money to me. Then I will recognize my income as a sales. Okay, there's a possibility, and I also know what is the expenses I have incurred. I have recognized. As soon as I sold him, and before the due date he got died. Then should I reverse it? Yes, you should reverse it. You should reverse it because if you have credited your income on the credit side of P&L account, then right on the debit side of P&L account has bad dates. You got the point? So, sir, what about the cash sales? Sir, cash sales, what is there? You already got the cash. So there is a 100% possibility you have realized your income. So first thing, and third point, you need to capable of calculating, or generally it is a calculating, or it is also called measuring of your income, of your revenue. Just I'm using word called income. Means, for example, you saying that I can sell my calculator, but I don't know what is the amount I'm going to get. Or you sold an amount, which my friend got into, like I said to my friend that I'm going to sell my laptop. Okay, then he agreed and he taken laptop. Okay, then I don't know exactly what amount, possibility of what is the amount I'm going to get from him. So in that case, I cannot say that my sales are 50,000 or 60,000 because I don't know what is the amount I'm going to get. So when you're capable of calculating what is the amount you're going to get, unless you're capable of calculating, just don't recognize your sale. One thing, first point, you can calculate, you can say that this is an expenses I have incurred to get this income. The first point is done, and it's not or, and you have that confidence that this amount will be receivable. Yes, I have a confidence. Yeah, you have a confidence, but you can say that what is the amount you're going to get. Okay, this provision generally you have to use when you are like For example, there is a, just think in this example, there is some item I was manufacturing, vaccine, COVID-19 vaccine I was manufacturing. Do as soon as I manufactured, should I recognize my income? No, because the sale is not yet made. First thing. Second thing, okay, the one person has came and agreed with me, but price is not yet determined. There's a no possibility that that will come out and I will sell to him and I will receive the price. Okay, so you cannot, when you cannot decide upon your price, when you cannot decide upon your receivability, so you cannot recognize your income. Okay, this is related to your profit and loss account. So this is a point you have to remember when you're doing your profit and loss account. Then next point, what we have to remember, the points we need to be remember, uh, when you're writing entries, it's very important that how it implies in your profit and loss account and balance sheet. Whatever entry you are writing, either it goes to profit and loss account or it goes to balance sheet. So every year your balance sheet will be tallied. It means that your assets are equal to your liabilities, so that your business will go for a foreseeable period of time. Then I just wanted to discuss here one point. There's a difference between what is meant by provision and contingent liability. So here you need to understand, before we need to understand provision, we need to do with the concept called conservatism. So this conservatism concept says that whenever you knew that you're going to incur any loss, then you have to recognize right now. Okay, that's called conservatism principle. But whenever you know that you're going to get any benefit, then you have to ignore that. Okay, so conservatism says like that. Let me tell you one thing. So for example, on the basis on the 31st March 2016, when I was preparing my financial statements, then this is I have a debtor. Okay, I have a debtor. He is to pay 30,000 rupees, but his due date was not in this year. It was in 5/6/2016, mean the next year. But he was died on this date. I come to know he was died on this date. So was it possibility that I'm going to get this money? The answer is no. The answer is no, because he's died and his son's not going to give me. Then there's a two concept. One is conservatism says as soon as you know that you're going to incur loss, so I'm going to incur any loss. And matching principle also says when you know that you're not able to get that money, then you have to reverse it. Yes, it is also applying to the matching principle. Then what should I do? The bad debt is not yet happened. The bad debt is not happened. It will happen in the 5/6/2016. But I know the bad debt will happen. So, but I don't know how much money the son will also pay. Whether he will pay 30,000, whether we will get 20,000. So when there is a possibility of any loss and you are uncertain about amount, then you will create a provision based on some estimated amount. Based on some estimated amount. When there is a possibility of any liability or any loss, then you are uncertain about amount. You know what is amount I'm going to be incurred. Then you will create what? Provision. So what is that? See, generally, how you will create the provision? What is the entry I will pass? Generally, this is the entry I'm going to pass. Provision for, if it is for bad days, provision for bad debts. Instead of bad debts, I'm just writing provision for bad debts because I don't know the bad debts is not first point, the bad debts is not it happened, and I don't know the amount. So I was just creating a provision. A provision for bad debts account debit to profit and loss account. So my sales got adjusted to this extent of animal. So I've created around, he has to pay me 30,000. I have created so around 20,000. I thought 20,000 may not be paid. So next year, as soon as bad debts gets incurred, then you will pass this entry, bad debts account debit to debtors account. You will reduce your debtors balance to debtors account. Then whenever I incurred bad debts, I came to know it is only to the extent of 15,000. So the real bad debts are to the extent of 15,000, the first case. What generally you will do, so this is a nominal account, so I need to transfer to P&L account. So what generally happen, for this purpose you already transfer provision in the last year. So what I will do provision for bad debts account debit to bad debts account. 15,000, 15,000. So my provision for bad debts account showing a credit balance of 20,000. Then from that I have removed 15,000 by debiting. Then 5,000 was there still on the credit side. This I will use in the future for another provision. Okay. And this year also you wanted to create a provision of 10,000 rupees. This year also you have a debtor of 40,000 rupees, but you are estimating he will not pay me 20,000 rupees. Okay, then you wanted to make a provision. Okay, now you already have a provision of 5,000 rupees in your books. Okay, so what you will do, you will not create 20,000, just minus 5,000, you will create a provision for 15,000 now. So creation of provision account, provision for bad debts account debit to P&L account 15,000, 15,000. So done, sir. Okay, this is fine. Then this year is done. This year is completed. Okay, you came to the next year. So next year when you came to know, you have created total 15,000 this year and you have a 5,000 of the carry forward 5,000 from the last year. So 20,000 is your provision. But I came to know he didn't pay me 25,000. The real bad debts was 25,000. So when the real bad debts was 25,000, I have to pass an entry bad debts account debit to debtors account 25,000 and 25,000. Then I have a provision of 20,000 itself. So provision for bad debts account, I didn't have much. I just have 20,000. 20,000 to bad debts account 25,000. So actually this year you have to transfer to the profit and loss account 25,000. But the last year itself you have transferred for this bad debt. Last year you have transferred 15,000 and before last year you have transferred 5,000. Okay, means your profit and loss account for this 25,000 you have already in excess of 20,000 you have credited. But now when it comes to C, when it comes to real, and it became 25,000. So what should I do from? So what I will do, profit and loss account 5,000. Right? So that is excess amount that if you will take from this year profit and loss account. So I'm telling this to because to give a clarity for you, this is the interest you will pass when there is provision for bad debts account. Sir, if there is a no provision for a bad debt account, so directly will pass bad debts account debit to debtors account. Then bad debts is a nominal account. Then you will transfer to the P&L account. That's what you will do. So this is provision. So what about the contingent liability then? Here provision is something you know that you're sure about the possibility of uh, possibility or probability of the thing is happen. I'm just interrelating interchangeably using possibility and probability. When we go for accounting standard 5, we will discuss what is meant by possibility and what is meant by probability, but to not to get into too deep, I just trying to discuss which is in a simple way. Okay, then contingent asset. Sorry, then next concept we're going to discuss is contingent asset and contingent liability. So contingent, so I just wanted to talk in a simple terms. Okay, we will be discussing this technical terms when we are doing the accounting standard 5. I don't want to accounting standard 5 for that moment. I wanted to talk about this technical terms, but I wanted to make it more simple. Okay, contingent liabilities. So what is meant by contingent liability? So we understood the provision so that we that is in a happening. Okay, one event going to be happen. So we know that, but we don't know about the amount. So we have created a provision. Here, it's not about the amount. It's not about anything else. It's about whether that event gonna happen or not. Depends upon whether that liability gonna happen to you or not. It depends upon happening or not happening of an event. You got the point? Whether I'm gonna incur this liability or not, I will be knowing whether one other activity will be happens or not happens. Okay, for example, which means, let's see, again I will try to explain. There is a court case. So this is a court case on cool drinks. If they lose the case, they need to pay what you call, they have to pay penalty. But thing is, I cannot decide whether they have to pay the penalty, whether I should not pay the penalty. I cannot know unless otherwise the court verdicts comes out. Okay, till that it is comes under contingent liability. The court case came out, but I was uncertain about what is going to be my deal, right? So the court case came out. The court said till court case comes out, it's a contingent liability. Then I have to show as a footnote. Yeah. Then court verdict came out. Okay, court said, you guys sit. This will happen in USA. You guys sit and talk. Okay, just decide what will be the penalty. So now I know there will be a liability. I know there is some loss I'm going to incur, but I don't know what is an amount. That time I will create a provision. So till contingent liability means your liability will be depends upon happening or not happening of an event. Okay, contingent means happening or not happening of an event. You get the outcome. Okay, it depends upon happening of or not happening of an event outcome. Then let me show, if you're getting benefited, if you feel you're getting benefited, you file a case against someone. If they lose the case, if you lose the case, you're not going to lose anything. But if they lose the case, they have to pay certain amount to you. Means it's called contingent asset. So if case upon you, means if you lose the case, you have to pay the money. Then you have to lose the money. Then it will call contingent liability. Okay, then when it comes to contingent liability, write on the footnote. If it is a contingent asset, no need. Don't disclose. But if it is a contingent liability, just disclose it. If it is a contingent asset, no need of disclosing. Okay, no mandatory of disclosing that. So we have understood. Sir, we should write an entry, sir. No, it's contingent liability. We're not required to write. Why we should not require it? We'll see in accounting standard 4. So then we will stop class here. Those people who are new to the channel, please subscribe. Those people who old to the channel, please press like button, and those people who haven't touched upon bell icon, just make sure that you will touch it. So we'll stop the class here. Have a great day.